Hi, everyone. I'm Diane. I'm from the Blackstone Public Library in Blackstone, Massachusetts. I'd like to welcome everyone to this Zoom presentation as part of the Blackstone Public Library's Financial Literacy for All Ages, a Formula for Success. This program, Investing 101, is brought to you with federal funds provided by the Institute of Museum and Library Services and administered by the Massachusetts Board of Library Commissioners. We have several dozen attendees for today's program, so I will be muting all guests during the presentation and ask that you hold all your questions until the Q&A session at the end. If you do have a question during the Q&A session, please indicate this by selecting the raise hand symbol. You can find this option by opening the participants window in the Zoom program. At the end of the presentation, I'll scan the participants for raised hands. Please have patience as I call on you one at a time, and when I call on you, I will unmute you so you may ask your question. Or if you prefer not to speak, you can type your question into the chat box and I'll read that during the Q&A session. Next, please let me introduce our presenter, Jonah Houle. Jonah has a bachelor's degree in finance from Rhode Island College with a focus in equity investing. Jonah has been studying stocks and the financial market for approximately 8 years, and he currently works at Shamrock Home Loans located in Rumford, Rhode Island. Now, without further ado, let me pass the program over to Jonah. Jonah, take it away.
Thank you, Diane. First, let me begin by thanking the staff of Blackstone Public Library for allowing me to speak on this important topic. My name is Jonah Houle. I'm a Rhode Island College alumni, class of 2019 with a bachelor's degree in finance, with a focus in equity investing. This presentation will be about an hour long, and I'll be answering any questions to the best of my ability at the end of the PowerPoint. In this presentation, we will cover the very basics of both buying and selling stocks and bonds. We will also cover definitions. What is a stock? What is a bond? When to buy and when to sell, etc. It's important to note, while I have background in financial markets and institutions, I'm not a financial advisor. I cannot answer any personal financial situations regarding anyone's 401k, Roth IRAs, or any other type of portfolios. I'm here to help you understand the concepts of investing in stocks and bonds. With that being said, let's jump into the presentation. Investing 101, buying low, selling high. Like I said, Rhode Island College graduate, 2019. I have a bachelor's in finance. I competed in the Adirondack Cup with other colleges around the nation. This is where we traded small cap stocks, competing with multiple schools nationwide, where we had $100,000 in assets across multiple stock selections. I currently work, as Diane said, in a mortgage company, and I currently manage my own portfolio. Please let me be clear. This presentation is not for financial advice. This presentation is only to educate participants in the market. Please consult with a financial advisor before making any purchases within the market. Here we go. What you should expect to learn from this presentation. We'll go over stocks, market and the vocabulary for stocks, how to start investing in stocks, how do they work, what different methods of investing, when to buy, when to sell, and then we're going to go over bonds. We're going to go over the market vocabulary, how do they work, when to sell, and when to buy. The market vocabulary. Some of you might have heard of a bear market. Now, a bear market is stocks when they're in a downward trend for more than 20% over 2 months. A benchmark is an individual's portfolio return against a designated index fund, such that like a S&P 500, a NASDAQ, those are all indexes where we see on like news stations, where you might see the NASDAQ, S&P 500, the Dow Jones is another great index. Those are all stocks pooled together into one fund. The bull market. A bull market is when stocks are in an upward trend, increasing. Now, if you go on Wall Street, they're going to have a bull here. That's what that represents. Diversity. It's important to diversify your stocks, your stock choices, your portfolio, so that you're not impacted in a great way or a negative way if one sector decreases. We'll go more into depth afterward on that. A dividend. A dividend is a portion of a company's earnings that are paid to a shareholder. So let's say you own a stock. You might get paid dividends quarterly or annually. A dividend is a small percentage of additional income to the stock. So you'll get the stock price, and then you'll get your dividend. Indexes, as we said before, is a reference marker for traders and portfolio managers, similar to the benchmark. For example, a 10% return may sound good, but if the market index returned 12%, then you didn't do very well, because you could have just put your money into an index fund and you would have done better. IPO, initial public offering. This is the first time a company is publicly traded to all investors. Some of you might be thinking of an Airbnb, an Uber. These are all new publicly traded companies. Normally they trade lower than other companies. Market cap. Market cap refers to the total value of all shares in a company's outstanding stock. Portfolio, a collection of investments owned by an investor. So you own many different diversified investments. You have your own portfolio. It's your personal portfolio. Stocks, shares, equity is a single unit of ownership within a publicly traded company. A ticker symbol. A ticker symbol is any 1 to 4 character alphabetical letters. So instead of trading, if you're looking to buy Amazon, they're not going to put Amazon as their whole ticker. They're going to put AMZN. Or Facebook is FB. So when you're looking at to trade stocks, look at ticker symbols. Then you have the yield. It refers to the percentage of return on an investment that is received from the payment of a dividend. So you have your dividend yield. That's what it's called. Done correctly, investing can be a great payoff. You have the best of the best, which is Warren Buffett, 89 years old. His net worth is $73.2 billion. You have Bill Gates, $64, $102 billion. And then you have Peter Lynch, $450 million. Done correctly, investing is a great payoff. How to start investing. Open up a brokerage account with any investment company. Fidelity, Charles Schwab, E-Trade, Robinhood. They even have apps that you could use. Banking, so what you do is put your banking information, your social security number, address, date of birth, and more that will be required. Note that most brokers take a commission of $4.95, at least Fidelity does. Speak to a representative if you have any question on fees, questions, or setting up your portfolio. Second, you link your investment accounts to your banking account. Search a company ticker symbol, purchase a share, now you're investing. That's what normal people think. So this is a question I know we get. So investing is like gambling? No, investing is not gambling. Investing takes a lot of research in the companies that we are investing in. How do stocks work? Companies sell shares or stocks or percentages of their company to investors. In return, companies use the money raised from the investors to benefit the company. The more stock you own, the greater the ownership in the company you have. The better the company does financially, the more money there is to be made for the investor. The worse the company does financially, the less money there is to be made. In some cases, if a company goes bankrupt, let's say you put money into Apple, and ironically 30, 40, 50 years go down, and they're going bankrupt. You could lose all your money. That stock could reach zero. So there is a risk-reward factor in stocks. So why do corporations need more money, especially large corporations? Corporations use money raised from the investor to do some of the following. They attain more inventory, pay off outstanding debt rather than taking a business loan, advertisement, and they do things that help them leverage the company. Rather than taking on more debt and more debt, they would rather sell off percentages, pieces of their company. The stock market is continuously changing. This is due to continuously buying of liabilities and assets and sales within the company. So if you have an Amazon stock, why is Amazon stock always changing? Or why is the S&P always changing? It's because these companies are continuously buying and selling. So they're constantly changing with the assets and liabilities that they're selling and buying. Also, it determines on the future hold within the company, also known as the futures market. So you might hear the future market for this company is doing really well. Stocks can increase or decrease based off of speculation as well, that the company may be doing good or poor in the near future. The definition of speculation, if you don't know, the forming of a theory or conjunction without firm evidence. So if you say, hey, this company is going to do really well in the upcoming weeks, they have something coming up, you should buy their stocks. That's buying off speculation. And you can get hurt during that. You can lose money during that if the speculation is incorrect. The following websites can give you up-to-date information and news within the market of any company for the day. Value Line. This is a good one. I used it in Rhode Island College, and the Blackstone Public Library has this tool as well. I definitely recommend this one. Yahoo Finance, another one I'd use all the time. It's an app on my phone. It's a great place for beginners. Not as much information as Value Line, but it is a great place. Then you have Bloomberg. Bloomberg is a great tool for spot-on news. In my opinion, they're faster than most nightly newses. So some people say, I don't have a lot of time to research. So what stocks should I buy? Well, that's a tough question. There are many different methods to investing. Warren Buffett uses the buy what you know strategy. So different methods to investing is trading off market caps. If you remember, small cap stocks from 300 to 1 billion, which is what I traded in the Adirondack Cup. These are companies that the average person hasn't heard about, like IPOs. They're big risk and big rewards. Mid-cap stocks, market capital, 1 billion to 10 billion in revenue. Large cap stocks are 10 billion plus revenue. These are the companies like we've heard of every day, the Walmarts, the Amazons, the Home Depots, the ones that you go to every day. Index fund trading. This is a good option for diversifying your portfolio. For example, the S&P 500 is an index of the top 500 large corporations in which you can buy a small portion of them in a single trade. NASDAQ, I believe, holds 3,000 if I'm not mistaken, and the Dow Jones, I believe, holds 26, I believe. It's a great long-term tactic to gain wealth. It's great diversification. Day trading. Top investors don't do this. You're going to see a lot of people doing this. A lot of social media influencers are going to push this method. Buy and sell stocks daily as soon as you make a profit. So this is a lot of looking at graphs, making sure you know when to buy, when to sell. A lot of top investors don't do it, and 80% of people lose money on this tactic. But it is a tactic, and people do it. Look at companies in S&P 500. Like we said, the S&P 500 is an index of the top 500 companies. They are all companies we heard of every day. Here's a list of them. They have a strong future ahead of them. Facebook, Amazon, Google, Coca-Cola. These are all great companies that have a great financial background who we know can go on for longer and longer generations. Some quick tips. Don't put all your eggs in one basket, meaning make sure your portfolio is diversified. You don't want to only have technology stocks in your portfolio. look at the different sectors. If you're looking at just technology stocks or just oil stocks or just industrial stocks, what happens if that sector goes away? That could put a financial strain on your stocks. Diversify. Don't put all your eggs in one basket. So, different sectors to diversify in. Energy has ExxonMobil, Shell, Chevron, all companies that we've heard of. Great companies. Industrials, Honeywell, American Airlines, General Electric. Healthcare field, you got United Healthcare, CVS, Walgreens, etc. Financials, JP Morgan, Chase Bank, Bank of America. Technology, Facebook, Amazon, Apple, etc. There's so many companies in so many different sectors that you guys could look in to diversify your portfolio to minimize financial loss if anything were to happen to one particular sector. So when is the best time to buy? Can I lose more money than I put into the company? If you're looking to invest over 10 plus years, really any time is a good time to buy. Market indices and fundamentally strong individual companies have a tendency to do well over time. Some experts suggest that becoming debt-free in your personal life before you start investing into the market. You cannot lose more money than you put in. You can only lose what you put into the market. So if you put $500 into the market, you can't lose $550, because if you're buying $500 worth of stocks and the company goes bankrupt, they have to sell out they have to liquidate all of their assets, pay the bondholders first, and your stock will reach zero. It will never be a negative number. But investing over 10 years, if you look at indices such as NASDAQ, S&P, again, Dow Jones, over 10 years, your markets have a tendency of going up, of increasing over that time period. S&P 500, like we just said, ideally you'd like to buy on the pointed red. Timing these are extremely difficult. So what you want to do is you want to buy in bulk when the market is in distress. Keep on putting money in the market, whether it's down or up. Stay in the market during stressful times. Perfect example, COVID-19. This is a stressful time. Unemployment rate is through the roof. Businesses are suffering. This is a perfect time to buy. Well, about a month ago, the stocks are back on the rise. But when the NASDAQ and S&P and Dow Jones were at lows, record lows, that was a perfect time to buy. Great buy in bulk. But you should have been putting money in consistently. If you put money in consistently, you limit the amount of financial how do you call it? Like negativity, losses, financial losses. There we go. So, okay, I'm well diversified in my stock choices. How long should I keep them? Who buys these stocks when I sell? And do I have to pay taxes on the money I made? All good questions. You can buy and sell whenever you like. Typically, the longer you hold on to the position, the better off you are, as we just seen in the last slide. When you sell a stock, it gets traded within the market to another investor who is willing to pay that given price. So let's say you wanted to buy at $80 and you want to sell at $100, and you thought the $100 was ceiling, it could go, it can't go any higher. Well, there's another investor who thinks $100 is a great buy, that he thinks $120 could be a cap. So it gets traded to that borrower. And yes, you always have to pay capital gains on any gains that you collect for the year. Always have to pay taxes. So how do you calculate capital gains? If you buy a company, X, Y, and Z, for $100 a share, let's say you buy one share of the company, The stock increases due to positivity in the marketplace. Speculation. It increases due to speculation. Your stock you bought for $100 is now worth $110. You decide to sell. What's your return? What's your capital gains? So what you do is you take the ending price of $110, what you sold it for, minus the starting price of $100, what you paid for it, divided by the starting price of $100. And you get just about a 10% return. You pay taxes on the capital gains, 10% you made. Conclusion when buying stocks. Every investing strategy is different. Warren Buffett said, investing in index funds over a long period of time, you'll do fine. But buy consistently. Don't try to time the market. Just keep putting a portion of the paycheck into the market every week. Buy in bulk when stocks are on sale and the market is in distress. Diversify into different sectors. If you're buying individual stocks, buy stocks that are fundamentally sound in revenue and have low debt. Holding on to stocks longer compared to shorter has a tendency to make a better return. Not guaranteed, it has a tendency. Markets have a tendency to increase. But make sure you diversify, especially if you're buying one company, individual companies. Diversify, different sectors. Moving on to bonds. Now, bonds is very different than stocks. We're going to go over some bond vocabulary. Bonds are sold by a company, town, or U.S. Treasury to increase funding. Just like stocks, they want to increase funding. So how do they do it? It's issued as a debt, a liability to the holder of the bonds. Bought by investors who collect a fixed rate of income, also known as a coupon, from the bond that has a maturity date. So let's say you have a bond and it yields 6% for the year. So you're going to get the 6% annually of the bond. That's your interest. Coupon, the interest collected from a bond by the bond holder. It's guaranteed the interest payment no matter how the company is doing. So it limits the risk. Bonds limit the risk. You might not get the upside advantage like stocks do. However, stocks are riskier than bonds. Credit report agencies, a company that analyzes and rates the quality of global bonds. Credit ratings, they designate used by credit report agencies to indicate credit quality, such as AA, BB, etc. We're going to go over these in the next slide. Corporate bonds is a corporate bond issued by a corporation in order to raise financing for a variety of reasons. For example, ongoing operations. And you get paid the coupon rate for the year, whatever it's yielding. All bonds yield a different rate. Default, when a borrower cannot pay their obligation to the holder. So if the borrower cannot pay the obligation, the debt, what happens is the companies liquidate all their assets. So if you have cars, if you have cameras, if you have anything that produces money, that money then gets paid to the bondholders first. And then later on, what's ever left goes to the stockholders. Again, that's why stocks are a little riskier. Face amount. The par value, the market value, appearing on the face of a security bond. It's the amount that a bond can be sold in the current marketplace. So let's say you want to buy a bond for $1,000. Well, the face value, the face amount is that $1,000. So you have the face value of $1,000, and you might have it yielding at 6%. So now you have that coupon for 6% yearly. A floating rate bond. A bond with a coupon rate that adjusts periodically according to a bond index. Junk bonds. Junk bonds that are rated below investment grade, as seen in the next slide. Junk bonds, which are more riskier investment, pay a higher interest rate, higher coupon rate. So instead of a 6, maybe they yield 12, 15, 20%. However, they have a higher rate of defaulting on the bonds. Municipal bonds. A bond issued by a local government or territory or one of their agencies. This helps finance roads, schools, airports, etc. Treasury bonds. These are probably the safest investment vehicles that you can make. Also referred to as T-bonds, are bonds bought from the government. They have a very low rate of return because of the safety they provide. So bond ratings. Treasury bonds are at the top. They're AA. AAs, A plus, AAs, those are your treasury bonds. Very safe. When you get down to the Bs, those are normally corporate municipal bonds, are still very good. And then you have your junk bonds, your high yield, your riskies. These are B pluses, Cs, sometimes Ds. These are companies that can't get bonds, that can't get financing from lenders, from other institutions such as banks. So they have to go to private people, private individuals like ourselves. How bonds work. Bonds are very different than stocks, what we covered. Bonds are a debt strategy used by a corporation, U.S. Treasury, or local agency. While stocks give you ownership and you have a limited upside, bonds are fixed. You can only accrue the gains on the coupon interest. Bonds limit the risk of the investment. Typically, older people have more bonds in their portfolio. So if you have a manager, he might say, hey, you're getting to your 60s, your 70s, your 50s, whatever he dictates, and say you might want to switch over to bonds, or we'll have more bonds than stocks. We'll still carry both, but we're going to have maybe 52, 55% more bonds. If a company goes bankrupt, bondholders' liabilities are paid first before stockholders. Bonds typically work inversely to stocks. When stocks fall, bonds face value typically rises. When stocks rises, bond face value typically fall. Prices of bonds are inversely affected by a coupon / interest rates. When bond rates decrease, prices or the face value increases. When bond rates increase, prices of the face value decrease. So what happens is that investors want to get paid the differential. They want to get paid for adding more risk. They want to be compensated for taking on the lower rate. So how do you do that? You increase the par value, the face value, and vice versa. If bond rates increase, they are getting 7%, so they're willing to take a par value, a face value of a little less because they're getting a coupon rate that's a little higher. So they work inversely to each other. How do bonds work? Continuation. Bonds are safer than stocks. However, they still carry their own risks. While stocks can fall to zero if a company goes bankrupt, bond investors get paid first. This is because it's a debt to a company that is paid when a bankrupt company sells all of its assets. When we're heading into a bear market, most investors switch to a bond strategy. So, when do you normally buy bonds? Buying bonds is not easy. Recommend looking at the federal government as regarding interest rate. There's a Fed calendar online. Remember, it's different than investing in stocks. You want to buy bonds when federal interest rates are peaking, because that means the face value will be lower. Remember, the higher the interest rate, the lower the face value, the less you pay. Interest rates fall when there's a decrease in the demand for credit. There's more money in the market. We see that now. We have record low interest rates. There's more money in the market. When to sell your bonds? Most investors don't sell their bonds. They typically hold on to them until the bond matures and collect the fixed income throughout the life of the bond. They're a safer investment to collect. However, if you're looking to buy and sell bonds, you should sell when bond rates are low. Inversely, bond rates are high, you buy. This will give you a good rate of return on your investment. Brief recap of bonds. Bonds are different than stocks. They're fixed income assets where you get the coupon rates until maturity. They're safer than stocks. You want to buy a bond when interest rates are peaking. Bonds are a good buy when the face value is low and coupon rates are high. Bonds are a good sell when the face value is high and coupon rates are low. There are a wide variety of bond selections: your corporate, your T-bonds, municipal, etc. Investing in all of them until maturity is a safe strategy and is a good way to make money. In conclusion, everyone wants to do well with money. We all want to do extremely well with money. We all love it. Investing in the stock market can be tricky. However, there's a tremendous upside. You do your research on the companies you invest in. Keep on putting money into the market every week, and you buy strong companies. Index funds are a great investment over the long period. It's a good idea to do a lot of research on the companies that you're going to invest in or looking to invest in, rather than just taking someone's word for it. If you hear it on the street, you should do your research on it. I listen to what the market is doing and what the big guys are doing, such as Warren Buffett. I look really what he's doing because I idolize him. I'd like to be like him. So I look to see what he's doing, what he's in. And then I make my decisions from there, do my own research, and do my make my decision off his basis. But don't dismiss the ideas of bonds so quickly. While bonds are not as attractive to the normal buyer, they're a great way of making money. You get a coupon rate, a fixed interest rate. It's not the upside that everyone dreams of, but it's fixed and it's safe. They're safer when the economy is in distress. If a company is in financial stress, bondholders get paid first. They liquidate their assets. If a company goes bankrupt and they liquidate their assets, bondholders are the first one to get paid, along with other debts that they owe. T-bonds, municipals, and corporates. Make sure you diversify. It is very important that you not only diversify in bonds, also in stocks, index funds. Thank you for listening. Any questions? As a reminder, this presentation was not for financial advice. This presentation was only to educate the participants on the market. please consult with a financial advisor before making any purchases within the market. Thank you.
Hi, everyone. It's Diane again. If you have any questions, please indicate this by raising your hand in the participants window. In the meantime, we do have a text question that I can read. It says, question, is investing in a company different than investing in the futures of the company, and how?
Investing in a company is not different than investing in the futures market. No, it's the same thing. You're just predicting that the future will do good, do better off.
We do have another question. Let's see. It says, is investing in index funds diversified enough?
Yeah, so an index fund, let's say, I think of an index fund as an Easter egg basket. It's it's a different approach, but that's how I think of it. And I think of companies as Easter eggs.
Okay.
Now, the S&P 500 is 500 eggs in a basket. So when you're investing in an index fund, you're buying the whole basket. So you're buying these small percentages of companies. So it's a great way to diversify. You're not just buying one company that could potentially have an upside or downside. So you're limiting the risk by buying the full basket.
Okay.
So I think that's a great analogy.
So it's like a box of chocolates. You might get a lot of caramels that are tasty, but then you get a couple of the fig flavored ones that nobody wants.
Exactly. Yep.
Okay. All right. That's great. What is the downside to an index fund?
So if we look at the S&P 500 chart, is there a downside? Absolutely. There's some points in red that are absolutely in the downward effect to investing in an index fund. But over long term, if you're born in let's say 2000s, right, and you're 18 and you want to start investing, and you're now 2020, you're now starting investing. Over the long term, over 30, 40, 50 years, there really is no downside to investing in an index fund. Markets have a tendency, if you look at the S&P 500 graph, to increase. There are some decreases at times. However, 30, 40, if you keep holding them, they'll do well. As Warren Buffett says, index these over a long period of time and you'll do just fine. And
then another question we have, what is your favorite aspect of Bloomberg for investment?
Oh, so Bloomberg, I used Bloomberg at Rhode Island College, and this is a very technical, very in-depth look of the market. If you're really into getting in depth in the market, I definitely recommend Bloomberg. They have tons of breakdowns with price to equity ratios, beta, and all that. I know I didn't explain that because that's a very in-depth look of it. So if you're looking to actually go more in depth, Bloomberg is definitely the way to go. However, the Bloomberg terminals are expensive. I think they're $1,500 just for the website. So it can get extensive. Obviously, do your research on purchasing one if you're looking. But however, they're a great tool to use. I used them in college, and very extensive, but up-to-date news within 20, 30 minutes. Like, so much.
Great. Hold on, let's see. What are your thoughts on target mutual funds, like a 2035 investment fund?
Yeah, so if you're looking to invest in mutual funds, you're able to look at the 12-year index, which 12-year spans. So you're able to see what it did. It's called trailing 12 months. So you're able to see what it done last year. You're able to see what it done the previous year. So just look for one that has a greater return than the normal index. The S&P 500 on average for 30 years gets 12% averagely. So if you could find a mutual fund for 25 years that has a greater average, like 15%, totally go for it. Absolutely. That'd be my recommendation.
Someone's just sharing some information about the Boston Public Library has a Bloomberg terminal in its public site.
Do they?
Mm-hmm.
Oh my God! So yeah, I can't even tell you the extensive research on Bloomberg. You could go to other countries and look at currencies and different the dollar to the yen. If you got it's so extensive. I do recommend it if you're looking into the financial markets for a potential future.
Sure.
However, if you're just looking for information, basic investing, I wouldn't recommend it because you're just going to get the first time I got really overwhelmed.
Sure.
Yeah, so you really have to be in depth. You really got, yeah.
Okay, well, the option's there. If people want to travel
Yeah,
to the Boston Public Library, it looks
absolutely.
like they have access to it. So that's
I
great
might do
news.
that. I might do that. That's
A
exciting.
little field trip to Boston. That's not bad.
Little field trip.
Yeah. Yeah, awesome. Okay. All right, it looks like that was the last comment, although I keep saying that and then another one pops up. Thank you so much for attending today's program, everyone. We want to remind you that this project was made possible in part by the Institute of Museum of Library Services and administered by the Massachusetts Board of Library Commissioners. With that, I'd like to say thank you to Jonah for his very informative presentation, and thank you everyone for attending. Please check out the Blackstone Public Library's calendar of events page, and thanks everyone. Thanks for attending. Be safe and stay well. Hope to see you soon.
Bye everyone. Stay well.
Thanks everyone.
Invest well.
Take care.
Bye.
Bye-bye.